Hey everyone, welcome back to Corporate Decoder, the place where we decode the mysteries of big business filings with a wink and a smile. Today we're diving into Wintrust Financial Corporation's latest report, and let's just say they've been busy with some important paperwork that could shape their financial future. Before we jump in, if you love getting the inside scoop on company moves and want to stay ahead of the curve, make sure you hit that subscribe button. Also, we've got a fantastic community brewing on Discord. Check out the link in the description below. Alright, so Wintrust Financial Corporation, or WTFC as you might know them on the stock market, released a report that basically tells us they've tweaked some of their borrowing agreements. Think of it like updating the fine print on a loan to make sure everything's up to date with new rules. And perhaps to get a slightly better deal, they've entered into what they call a fourth and fifth amendment to their credit agreement. Now, these amendments, while sounding a bit dry, are actually pretty important for how the company manages its money and its access to funds. Let's break down what these amendments mean. The fourth amendment, it has a few key points. First, it includes new rules related to outbound investments. This means Wintrust has to make sure its investments outside the US comply with new government regulations designed to control certain types of foreign investments. This is becoming a bigger deal for a lot of companies in today's global landscape. They also added some protective language to their confidentiality agreement, which is pretty standard stuff companies want to make sure their sensitive information stays private. But the big news here is they've extended the date when their revolving credit line matures. This means they have more time to pay back that particular loan, pushing it out from December 2025 to December 26. This gives them breathing room and certainty about their access to funds for the next year. Then there is the Fifth Amendment. This one is focused more on the cost of borrowing. Wintrust has managed to lower the fee they pay on the unused portion of their revolving credit commitment. It's going down from 0.30% to 0.25% per year. Now, to some that might sound like a tiny change, but for a large corporation that has a big credit line, it can add up to significant savings. Lowering these commitment fees means more of the company's earnings can stay in its pocket instead of going to the lenders. It signals that Wintrust might be confident in its cash flow or is actively seeking to optimize its financing costs to boost profitability. Now, because these agreements are considered crucial to Wintrust's financial health, they've attached them as exhibits to this filing. You can find the Fourth Amendment as Exhibit 10.1 and the Fifth Amendment as Exhibit 10.2. We can't go through every single word because that would put you to sleep faster than a tax audit, but the key takeaway is that Wintrust is proactively managing its debt and credit lines in line with new regulations and aiming to cut costs. Digging into the details of the Fourth Amendment, we see it addresses regulatory changes that affect outbound investments. This is a critical point as global trade and investment regulations are constantly evolving. Companies need to be agile and compliant to avoid penalties or disruptions. By updating their credit agreement, Wintrust is showing it's staying on top of these complex international rules. The extension of the revolving credit maturity date is also a strategic move. It provides stability and ensures that Wintrust has access to funds it might need for operations growth or unexpected expenses without the immediate pressure of refinancing. The Fifth Amendment's reduction in the commitment fee is a direct win for Wintrust's bottom line. This fee is paid on the money a company has borrowed but not yet used. Lowering it suggests that either Wintrust is using its credit line more efficiently or its lenders are offering more favorable terms, potentially due to Wintrust's strong financial standing or a competitive lending market. This kind of optimization is exactly what smart financial management looks like. It's not about a massive surge in revenue, but about making sure every dollar spent is as efficient as possible. While this filing doesn't contain deep financial tables like a quarterly earnings report, it is more about the operational and financial infrastructure the company relies on. Think of it as adjusting the plumbing and wiring in a house to make sure it functions smoothly and efficiently, especially with new building codes. The credit agreement is the financial plumbing for Wintrust. Now, looking at this from a higher level, Wintrust is showing us a company that is proactively managing its financial resources. They are not reacting to problems, but rather anticipating future needs and regulatory shifts. The extension of their credit line offers a buffer, and the reduction in fees boosts efficiency. This indicates a management team that is focused on long-term stability and cost savings. It suggests that despite the complexity of the language, these amendments are positive steps for the company's financial health and operational flexibility. It's a sign of responsible corporate stewardship. So what's my take on all this? Wintrust is demonstrating a solid grasp of financial management. They are adapting to the evolving regulatory landscape, especially in international investments, and are actively working to reduce their financing costs. This proactive approach to credit agreements is a strength. It provides a stable financial foundation. The risks are always there with evolving global regulations, but Wintrust seems to be navigating them with careful attention. The opportunity here is clear. They are freeing up capital by reducing fees and gaining more time with their credit facility, which can be reinvested into their business or used to weather economic uncertainties. My conclusion is that Wintrust is making smart strategic financial adjustments that should benefit the company and its shareholders in the long run. Alright, that is our breakdown of Wintrust's latest filing. What's your take on these financial adjustments and what do they signal for the company's future? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into the world of corporate finance. Don't forget to check out our Discord community linked in the description for even more discussions. Thanks for watching, see you next time.